So we started this week with a very strong move to the upside. Very good news from a vaccine standpoint. The potential for a result in the election that got people going over last weekend. We didn't really follow through though on that open Monday very strongly. And I'm going to kind of show you why not, why we didn't really extend the breakout that we started and what that means on terms of whether or not this is a breakout and whether or not this is a start of a run. And if this is the start of an intermediate run, what kind of run will it be? So we're going to break all that down, what our leadership was like this week, especially on Friday. How did we close? Did we get a good strong close that can lead to more strength next week? Or is there expectations that it wasn't strong enough going into a new week? So I'm going to break all that down in the video today. Then we're going to take a look at a stock that's itself is not really breaking out, but it's not breaking down either. What kind of range is it? What does its charts look like? And what kind of trade does that lead us into for that? So let's go ahead and get started. Today is Friday, November the 13th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. And we can see the nice good update that we finished the week on, closing above the high on Wednesday, obviously not getting above Monday's high, where we gapped up pretty significantly and then came down almost from the start. Brief move to the upside, and especially on the futures contract. The futures contract, there was even more of a move higher Monday, and you can see the long upper shadow there. We're kind of getting the same thing so far this weekend, right? We're starting up pretty strongly at 0.75% almost to the upside. Again, still inside that range though. That upper end of that's a pretty decent resistance level. Though we are getting, again, dark green shading, green line, relatively bullish from that perspective. Not on the cash index, because the cash index hasn't started yet. That waits until Monday morning. So we'll see what happens once volume kicks in, whether or not we can hold this overnight very low volume move when actual volume kicks in. Last Monday we couldn't. Once volume kicked in, we sold off that move pretty strongly throughout the rest of that day into the next day. So we'll see how things turn out once we open up here on Monday morning. But of course, we got strong short-term sentiment bounced back up at least on Friday. The near-term line getting back up here, then the momentum line bouncing up from oversold levels. We still have, like I said, light pink shading, but not on the Russell. The Russell's got dark green shading and a green line. The Russell's been outperforming. Interestingly enough, the long upper shadow that we have on Russell at 1745 is actually still holding on a close as a resistance. We traded up inside the range of that long upper shadow all week long and have been unable to close above it still. Now again, we'll see how that plays out once we start a new week. But as of right now, it's been unable to really take hold and close above there. Remember, closing above that high is more important than trading above it. You look at the NASDAQ composite, not even close to Monday's high. Remember, Monday's candle was a much more significant bearish candle in that it was a bearish reversal pattern. And we got back below the 78% Fibonacci retracement after barely closing above it. Got back below it. In fact, we were down inside the retracement zone again. We're still below the 78%. So the NASDAQ, unlike for the Russell, which remember is above the 100%, like it's above these highs here, that the September high that we got, it's been trending higher. The S&P is not above its September high point yet, just a little bit, actually, a little bit close, but obviously that closes up there. And then we're not above that high point. That's why we're still kind of at that 100% level, but at least we're above the 78%. Not the case for the NASDAQ, still below that. So again, this is our leadership. So as we go into the new week, you want to see that leadership take hold and get back above here and nullify that engulfing pattern, which in and of itself is a relatively bearish pattern there. So bullish pattern, just not strongly bullish yet. Obviously not bullish enough to be the beginnings of an intermediate run, like we see typically when you get a good move to the upside and we get the intermediate line up in the upper reversal zone and we're breaking through, and that's not really the best example because we're coming off such a strong low point. But you can see over here coming up off an intermediate low, you get a strong move to the upside. The intermediate line gets up in the reversal zone. The near-term line, momentum line spikes up. You feel really confident about, same thing over here, you feel really confident about the move to the upside. We're not getting that kind of move here. A little bit of a spike in the short-term sentiment, but remember that ended up being a fake out. And we're not getting a short-term spike in sentiment now to really confirm that this is a breakout. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and you want us to do another video again next time. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, click that thumbs up icon there. It's a great way to give us feedback and gives our videos engagements, and YouTube will promote our video to other people as well looking for this type of content. Comment too down there. What did you get out of our video today? What stood out to you? Why did you like it? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. There's my handle up here at DavidSettle42. And then join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out our classes we have coming up. Over here you can see on the right we have our top-down trend trading class that Brandon teaches on Monday mornings, as well as his long-term options class, or options for long-term investors, excuse me, and then the dividend growth investing on Tuesday mornings. So these are some of our most popular classes, especially these two, top-down trend trading and dividend growth investing. You probably, if you follow Brandon on Twitter, you've been seeing some of the great things they've been doing in that class. He shares some. You can come down as well and see some of the content that we put out for those individual classes. Also come over here and click on this heart that opens up this new window. Hit that like button right there. Also come over here, hit this thumbs up icon. It also takes you to your Facebook page, and hit that like button. Again, the more you do that, the more engagements these things get, the more Twitter and Facebook will promote our content to all of our followers, not just 129 of them. It also benefits you because because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the long-term chart, and we can see, now that we've finished up a week here, very strong bullish candle there. That's about a breakout of the candles you can get on the S&P 500. We obviously didn't close above that high, but pretty darn close. So, and we're going to start off at 35.85. We're probably going to start off higher than that, depending upon how we trade over in the European session overnight. But that's about 100 points off of where the open is going to be. Plus some, because again we're up a little bit in the after hours, the extended hours trading. So that's a really good bullish candle. You know, again, we talked about if this is the beginning of a new intermediate run, not to expect a nice long 13-week rally, but more like maybe a 3 or 4 week rally before we kind of run out of gas again. Because again, we never did test that 200-day moving average after this, and again the PPO is already very high, relatively speaking, so it limits the upside. Doesn't mean we can't go up, it just limits the upside, and especially the length and the duration of that upside. So we'd expect it more to be on the shorter end of the expected range, say 1 to 3 months. So one month, excuse me. So about maybe 3-4 more weeks before it runs out of gas and starts limiting the returns again. If you take a look at the Russell 2000, again, nice, good bullish breakout, but not nearly as of a breakout as we saw. I mean, while we are trading way up here, close to the highs, you can kind of see again how far back we've been. And if you look at where its PPO is right now relative to where it's been in the past, we've been stronger. There's been other times where we've been stronger than this. 2013 notably, 2010, 2011 coming off some really strong levels. So we're kind of at this point where it's at an opportunity to either hold this resistance with strong momentum already to get to this point that we've seen in the past, or break out and kind of do a slow grind like 2013, where again we had more of an incremental increase to the Fed's balance sheet that kind of helped fuel that run. We don't have an incremental increase right now. We had one big boost, similar to 2009, and then that kind of ran out of gas before you had QE2. See, that's QE2 right there. That gave it that boost. Later in the year. So we had a boost already. That's what lifted us off that COVID low, and now it's kind of on its own going forward from there. I did want to take a look at the market forecast on a weekly chart, and you'll see here that look at that near-term line bouncing right back up, and you can see the candle that we got this week, a little bit of a kind of a shooting, like a spinning top. Here was a breakout, above that 78% line, but again, a spinning top pattern, not the most bullish of patterns there. So, kind of keep an eye on how that turns into next week, especially if we end up with any kind of evening star candlestick pattern. The intermediate line never did come out of the reversal zone. So again, we never did get, a good test of that 30-week moving average like we've seen in the past with light pink shading and a yellow line. And we're well off of it again already. So, it's not very. We've just like that. We're pretty darn bullish. In fact, if you look at the Russell 2000, we got a cluster on the weekly chart. I mean, that's to get a cluster on the weekly chart coming off of this low point that we've had. That's pretty significant. Now, when you get a cluster at the beginning of these runs, that doesn't mean that we're going to have a bearish run here, but you can tell that it did lead to some weakness. It did lead to a move back to the moving average before you got going again. Then you got a cluster, and it led to a move back to the moving average. Then you got a cluster, and then it led a move back to the moving average there, and you got a cluster, and that again led a move back to the moving average. So it's not a bad thing to get a cluster at the beginning of an intermediate run. There's 2009, here's 2012. So it's not a bad thing to get a cluster. It just means that we might not necessarily go straight up from here now, because it's made such a strong move to get here to this point, especially as you can see in the last 2 weeks, more than what we saw on others. And then you look at the NASDAQ composite here, which is a little bit different. I mean, it's been flirting with the cluster itself, and it got a little bit of a hammer pattern going on with a lower shadow, which is not as bearish as an upper shadow is. And you can see that a little upper shadow that we got, which is not that significant. We've seen upper shadows bigger than that, but it's still acting as a resistance level, that high from that first week in September. Take a quick look at the 3 green arrows. As you can tell, obviously we're getting 3 green arrows still. The momentum is kind of peaking on the S&P 500 at least. You can see the histogram kind of rolling down. Not necessarily on IWM, but still you can kind of see how it's trading inside that candle. QQQ, you can see too that again that engulfing pattern, and we're still above the 8-day moving average on all of these, but again, not the same momentum. And even on IWM, the stochastic indicator traded below its moving average because we were so far off of that high point. So if we're going to really kind of take off from here, we need to get above that high point to feel confident about this being a bullish breakout or not. All right, now let's take a look at the intraday chart, and you can see the move that we had, but you also see the gap that we started off with on Friday that we haven't filled in, and it's it doesn't have the characteristics of a runaway gap at the beginning of a move, like maybe this one was in early November. It doesn't have the characteristics of a breakaway gap that we're breaking through a significant resistance level, with not filling in. You could say that one did, but then we didn't hold the gap. We filled it in almost immediately. So which makes it more likely a common gap, which means there's a good chance that ultimately we fill that in before all is said and done here. So just kind of keep an eye on that here early next week for that to get filled in. And remember, Thursday's gap from the election week, that's already been filled in on the Qs. So there's a good chance it gets filled in right there. There's the Thursday gap. It's already been filled in. And some of the election day gap, the post-election day gap, got filled in too, just a little bit. So keep that in mind. You can see this gap on Wednesday hasn't been filled in. This wouldn't be considered a runaway or a breakaway gap either. So a good chance that gets filled in. So we're not out of the woods. These moves to the upside and pre-market trading, Those aren't the best things. It's better to start down and then work your way through, like sell off on very light volume in the after hours, and then fill that in with volume and then finish at the highs. But when you don't do that, when you get most of your gains early in the morning and you don't fill that back in with some real volume and then make your way higher, not necessarily the most bullish pattern. It means ultimately that we probably will fill that in with volume eventually, sooner rather than later. Of course, nothing's 100%, but unless it's got the characteristics of a runaway gap, like we talked about before in this area, or a breakaway gap, where you're breaking through a significant resistance, none of these have those characteristics from last week, whether it's Wednesday or Friday, which means that there's a pretty decent chance that sometime early this next week that we fill those in. Keep that in mind too. You can see the volume on Friday below average range, very very low average volume on Friday. So the up days that we've gotten this week on Wednesday and on Friday have just not had good volume, and as you'll see here later in the session, doesn't have good leadership either. As you see that we're still very high in the ATR, we haven't broken the 1% level. So we're not breaking levels yet. We're flirting with this 90% mark, but we're not breaking levels yet that would suggest that we're breaking out. Getting below this 90% mark would be a very good sign, and holding that, while also breaking below 20. And you see that's not happening yet either. So very important here early this next week that we either break down, or if we bounce up, again, as you can see we've done a couple of times last week, if we bounce up off of these lows, and move back up to 95% or higher, then again, that means we're not done with this intermediate pullback that started in early September here. We're not done with that yet. We're just hitting a low point for support on volatility, and now we're going to bounce back up into this bearish range. Bearish for risk appetite, bullish obviously for volatility. So to summarize the market outlook here, our technical outlook at least, is, it's a great week. It was a bullish week. It would have been better had we held the gap from Monday, but we didn't. But at least we held up towards the upper range of this last week's trading. So there's some positive signs that we are starting a new intermediate run right now. Unfortunately, without the nice good test of that 200-day moving average, more than likely we're not going to get that long of an intermediate run if this is indeed the start. More likely maybe just a few more weeks before we get what would probably be by then a more painful exhale, simply because we'll sucker too many people into being more risk on than they should be over the next few weeks. Not that if you're positioned normally, if you understand the type of trend that we're on, then you might not over position size and wouldn't be that painful for them. But the problem is most people are going to view this as a breakout, as like a back up the truck, here we go, we're taking off here. And we just haven't had the exhale, the foundation built to be able to support that type of move without more of an exhale eventually. Again, we barely scratched the surface of that 23% retracement after a multi-month run that just took off that COVID low point. So it'd been much better had we pulled back a little bit more towards support. We didn't, and we might be passing up now. Though, even though I still lean towards, there's still probably going to be some more weakness before we actually take off. So I'm not in the camp yet that we are even starting a short intermediate run right now. I think we're kind of faking people out here this past week, mainly with that Monday close above, and we haven't been able to really follow through on that, and I don't expect that we will even this week. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree. Why? What do you see? What breakout signals are you seeing that suggest that we are in back up the truck mode, and we are expecting a much longer than a few weeks intermediate run here? Or maybe you're a lot more bearish than I am, and what are you seeing that suggests that? Share that with our community down in the comment section below. All right, now let's talk about what's driving this price action. You can see on this 3-month chart the big returns that small caps have made. And again, just looking at off of that Halloween low point, actually the 1030 low point, but since that low on 1030 from Halloween going forward, here Halloween's actually on a Saturday, but you get the idea. Coming off of that Friday low point, look at that small cap stocks just really outpacing. The Q's underperforming. Q's actually outperformed briefly their post-election day here. There's the election day, post-election. The Qs finished that week strong, but then this week you can see small caps took off, and then the Qs underperformed. So when you look at this week all alone by itself, here, right there, then it was small caps. Small caps, the Qs were actually down for the week. They started off up, but they ended up down for the week. Gold was obviously down with a strong move to the upside in the dollar, not your most bullish risk-on move. That also limited emerging markets gains, which had been an outperformer here. So, like right now, like the bullish move is weakness in the dollar, strength in tech, the Qs, obviously weakness in bonds, though bonds finished well off their lows, still down, but off their lows. Weakness in bonds and strength in emerging markets. That's not what we got this week. We got strength in small caps and developed markets. That was obviously a play on COVID, like the vaccine news that we got on Monday, and it held up all throughout the week. Remember, the developed markets are the ones that are in lockdown mode. So this move this week was more of a reactionary move, more of a, it's still kind of a follow through on some oversold levels in some of these areas, whereas our leadership didn't really take off like you would expect that they would if we were in a true kind of risk on mode here. Let's take a look at the yields. Yields have really making a strong run. I said they were off their lows. You can see yields were off their highs. A little bit of a pullback, but you can see the intermediate lines above market sentiment. It's on a nice strong trend. A little bit of a bullish intermediate confirmation signal type move going on with the near-term line getting. So we've seen this before. You get these little bounces and then yields move up. Getting closer to that 1% level. If you look at the yield curve, which we pay very close attention to, as we move up off of these levels. Now, granted, back in 2007, the yield spread rose as the interest rates were falling. If you go back to some of these other levels, the yield spread moved higher during a bullish move in equities. Same thing over here briefly, but you can see how the yield spread moves higher during that type of move. So more often, yield spreads go up when they cut short-term rates. This time, yield spreads rising from them raising, from them leaving them down to zero, and the long-term rates move up. That doesn't last too long. Might last another year or two, but you can see eventually the short-term rates will catch up, and that brings us back down to zero. So I don't think that we'll get all the way up to 200, 250 basis points again, because that generally happens in a bearish market when you get those big moves. But we have to get them up high enough to where once we do cut to zero, that it can jump up to 200, 250 basis points. The 10-year note's too low for that to happen now, obviously. So I think there's going to come a time where eventually the 10-year does move up to 200, 250, 300 again, and we start raising short-term rates again eventually. But not until you start to see, you can see during this period of time, by the time they started to raise short-term rates, you can see that the long-term yield moved up, short over about a year or so before they started to started to raise interest rates, and that's what brought us down to a inverted yield curve again. So what that says is I think there's a good chance that we'll move up higher on the 10-year note, and there's a good chance that we might have a pretty extended rate hike environment eventually, to the point where we get this pretty decent size gap here for a while, where it moves up. The gap moves up as both lines are moving up. That's kind of what happened in a couple of these little areas, but especially here in that little section there. So, but that's kind of what's going on with the bond market. I fully expect that the yields will continue to make their way up to a golden cross environment. As you can see, those tend to be pretty bullish when you get these golden cross environments on yields. We haven't had a whole lot of those. We've been pretty bearish on bonds, pretty strong bear markets on bond yields for a long time. So there's a good, there's more than likely we're going to start moving up towards a bullish run, where the dollar falls. You can see during this period of time, during these bullish periods of time, the dollar falls, right? So you can see the dollar fell during there, the dollar fell during there. We see the dollar's already falling here, so you can see how those two things would go hand in hand with rising inflation expectations, weakening dollar, rising bond yields, rising commodities. You can see this commodity basket is flirting with its own golden cross, finally getting above the 200-day moving average here for the first time in a while on a good bullish type breakout pattern of its own. So again, you can see that this basket typically does well in a bullish market environment, bullish risk on market environment here. And I expect that it will be that case here, led by a strong move to the upside in crude oil, which has got to kind of break above this $45 level to feel really good about a breakout to a golden cross there to support this idea of rising inflation expectations. So I mentioned the leadership this week not being the best in terms of risk appetite, like a risk-on type move, and this is kind of what I'm talking about. If I were to go looking at the week that was, we started off really strongly in real estate and financials and industrials and materials and energy, and that's what ended up holding up. And down here at the bottom, communication services, discretionary, technology, you can see healthcare. Those are your biggest sectors in the S&P. You can see the black line will gravitate more towards those sectors. So if those sectors lag, then the black line's not going to have nearly the gains. I mean, look at financials up 8%, energy's up 17%, the market was up 2%. That's not, that's if these three, technology, discretionary, communication services, if those three were these three up here, then you would see the market would have been up maybe 4.5 to 5%. But it was only up 2% because we don't have that leadership. That wasn't our strongest leadership, and it hasn't been since that move off of, the last 2 weeks, since the move off of that 30th low point on Friday. And we haven't had the leadership in those areas. Briefly technology, but like I said, since this week, it lagged. And then there's utilities, not surprising that safe havens will lag too. But energy, financials, and industrials are not the three sectors that typically lead moves. We saw them lead another move before back in June, right? Back in, where was it from about? Let's see here. It was back to June. Or was it off of this low point and on the 13th, so starting on the 14th all the way up to the 8th, June the 8th. So May the 14th up to June the 8th. We saw those same small sectors lead the markets higher there. Energy, financials, and industrials. Materials as well. 20% moves, but these sectors lagged. Discretionary did okay, but these two sectors lagged. And then we saw what happened after that. Post from June 8th to the end of June, I think it was like the 26th where it finally ended up stopping the declines. They all pulled back strong, and the market itself pulled back while these sectors led the way. And then eventually from that low point higher, from the 26th all the way up to that November 2nd or September 2nd high point, that we had that started this intermediate pullback that we're on now. Again, discretionary, communication services, and technology were up there. Materials and industrials did well too, but they didn't. They can go up. They just don't typically lead. These three sectors are the ones that lead. Those are the ones that we want to lead. Financials lagged, industrials lagged, or energy, lagged. Not surprising that real estate and utilities would lag in a rising yield, but you see the participation by the leaders we want to lead. They led us up on that upside during that strong bullish 16% run that we had from that June low point. And really you can see it was actually the June 29th that we'd want to start that. June 29th, so off of that low. Market's up 19% off of that low point, and you can see the leadership up there. With materials and industrials lagging, still doing very well, but lagging behind what we want to be the leaders. So we're not seeing that right now, which means we're probably going to have more of that June type peak more than another run like this, a new multi-month intermediate run led higher by the big dogs. All right, so for our trade idea of the day, I wanted to take a look at a stock here in the home building area, and that is DR Horton. It's, you know, it's been flirting. It's on its own with that 23% retracement of its own natural rally. It's got dark pink shading, red line. You know, it also had a cluster here. It actually kept going it to this October peak, so it never really did get that September pullback like we did in the broader market, but it has had one since that October peak with that cluster. Intermediate lines rising, still in the lower half. Not very bullish, not very bearish either. You can take a look from the long-term crossover. You can see that it's, you know, that we are kind of stalling here with some transition candles, with falling. You'll see a kind of theme here: falling PPO, which means that we're losing some momentum. Doesn't mean we're tanking, but we're losing some momentum here. If you look at its bandwidth, it's falling. We had a nice little pop in the bandwidth, but it's been shrinking now. You take a look at its DMI, you see that the ADX had been very strong. It's been pulling back. You look at its Ichimoku cloud, you get the theme that we just don't have a trend anymore. We don't have a strong bullish trend anymore. We don't have a bearish trend either. We're just kind of sideways and stuck sideways. So that sets us up for, you know, an opportunity where we can do a iron condor spread and try to profit from it stuck in this area with some room for it to move up, room for it to move down throughout this time before December expiration. You can see the trade there. We sold the $67.5 and $80 options here, right around the 20 deltas for the 67.5 and the 80, and then obviously went long for protection there on either side. So that sets us up for this condor, and you know, as long as we stay in the middle, then we just kind of make money from time decay. But all these options expire worthless, and like I said, it's got room to the upside to work with. It's got room to the downside to work with. There's my break even, so a little bit of risk to the upside, more risk to the downside. But again, we have some support. We've already been testing lows, especially from Monday's low. With the Harami that we had after that, we have some pretty strong support down in that area from a candlestick, not from a volume, but from a candlestick formation. So we'll see if that ends up being the case, and also had the earnings too. That was wasn't just the Monday morning, but the earnings that came out after that. So we don't have to worry about earnings going into December. It's a seasonally slow time of year. You can see what happened last December going into expiration. It just went flat. And so if it does something similar and we just kind of stay in this middle range, in the middle quartiles of the bandwidth, then that's how we make our money on the trade. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It goes to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. The point of that community is to keep this conversation going with yourselves, right? With our market scholars community and those that watch our Market Outlook videos. That forum is free for any of our free subscribers. The rest of our class forums obviously are for our premium subscribers, but the Market Outlook forum is for all of our subscribers, including our free subscribers. So participate there and engage with each other on what you're seeing and what you're thinking about Market Outlook and things that you're looking at. As always, thank you very much for watching. Remember to subscribe to our YouTube channel so you get notified when these videos are posted. Comment on our videos. Hit that thumbs up icon. Like it on Twitter and Facebook as well. Thank you as always for watching. Have a great rest of your weekend, and we'll see you all on Monday.